The advanced decline indicator, also called the advanced decline line or breadth indicator, provides a general idea of broad market sentiment. It does this by providing a ratio for a given market, such as the New York Stock Exchange. The ratio is formed by comparing the number of stocks that increased in value to the number of stocks that decreased in value. The magnitude of the advance or decline is not measured, rather just whether it is an up or down day for each stock. That way, stocks are equally weighted based on whether they went up or down and not the magnitude of price movements or market cap. Such unequal weighting often skews an index, which can be disproportionately affected by larger cap stocks or movements from certain stocks. The value of this indicator is a cumulative number. It continues from day to day based on the previous day's value, combined with the value of the ratio on the current day. If you want, you can easily find the calculations for the values that are displayed. The main focus of this tutorial will focus on practical, real-world application of the indicator on a variety of charts. So no matter when you watch this or which charts you choose to apply the indicator on, the general knowledge from this series of examples will be of use to you. When more stocks are increasing in value throughout the whole market, the ratio for the advanced decline line continues to be positive and continues to increase. In other words, the breadth or majority of stocks in the market are increasing in value, and the opposite is true when most stocks in the market are falling rather than rising. The advanced decline line will be decreasing and heading down just like the majority of stock prices in the market. However, the movements of an index or an individual stock don't always go in sync with this indicator. Later examples will examine the impact of short-term divergences, where a chart is out of sync with the advanced decline line for various durations of time, and we'll see what kind of inferences can be made when the movements of the advanced decline indicator are closely mirrored by price on a chart. An individual stock, index, or ETF of an index can still use the advanced decline line for the confirmation of a trend. It will usually be in the short term, such as during these key swing points during the larger downtrend, that closely coincide and sync up with the movements of the advanced decline indicator for a short time. This indicator shouldn't be used as a close representation of support and resistance areas or trend lines that relate to price, since even over the short to medium term, there can be drastic differences between the movements of a chart's price and the indicator. Since this indicator is essentially a tool to compare a chart to the rest of the market, an individual chart, even for a stable stock or index, will usually sustain a movement in one direction for much longer than the advanced decline line. This makes sense since the broad market has less potential for volatile movement compared to a single chart, and it would be less common for sharp movements to be sustained across the whole market for even a short time. In this example, the indicator helps confirm the start and continuation of the downtrend at those key points where there's synchronization between sharper drops in price and a sharper decline of the advanced decline line. In the past few weeks, the indicator has risen sharply while price has only begun to go on a more neutral to bullish stance. Though in any case, the general movements for this shift in sentiment can be seen on the price chart and the indicator. The close synchronization of movements that follows helps determine the increased chances of continued moderate uptrend development, which did end up happening. Again, trying to plot support and resistance areas or trend lines on this indicator isn't so useful, since close synchronization of movements with a price chart usually won't be sustained for a long time. It's more useful to focus on short-term synchronization of movements. At the start of this example, there's clear confirmation of an uptrend with sustained synchronization between the indicator and price. It's then followed by a great demonstration of divergence. The price of this individual stock goes against the broad market where most stocks are falling. This means stock price is going against the market when there's a key reversal for most stocks in the market. The end result is a strong reversal as this individual stock eventually catches up with the sentiment of the majority of stocks in the stock market. During the development of this early bullish trend, there's a similar result happening, where divergence has the price of the stock going higher, while the majority of stocks in the market, as represented by the indicator, begins to decline. Then with the more recent pair of heavily bearish candles, price on this chart is getting back in sync with the movement of most of the stocks in the market. This demonstrates how divergence can be a leading indicator of sorts before a chart gets back in sync with the rest of the market to begin a new reversal. But this is just one single indicator. Even when there are great conditions in terms of divergence and synchronization, major reversals and continuations aren't always guaranteed. So it would be wise to also use other analysis methods and look at the broader context. Like with other indicators, gaps on a chart can cause some disparity between what happens with price and the advanced decline line. In this case, there's no major divergence and it's mostly limited to that first candle that gapped up. After that, we see a relatively normal behavior with price filling in the small gap up and some congestion. When there is a stage of more horizontal movement with both price and the advanced decline line, there is not much to do except wait for a price to make a decisive break out of the range. Soon this does indeed happen, and we see another case where there's a sharp move in price higher during a gap up, while the advanced decline line remains essentially flat. But within just one day, this stock's price catches up with the market trend towards bearish movement. Even in this case, where there was relatively close and sustained synchronization between the indicator and price movement, we can still see if frequent, albeit minor, discrepancies between when reversal points take place on the price chart and the indicator. And with the recent surge in bullish activity reaching the highs of this range, there's greater confirmation for the continuation of the established long-term uptrend. And just like swing points, the breakout point won't always be an exact synchronization between the indicator and price movement on the chart. When bullish sentiment inevitably decreases and a reversal begins to form, there's a good example of how a sharp peak on the advanced decline line can help sway sentiment towards a more bearish posture, even though price movement on the chart is more neutral to bearish, rather than being immediately and definitively bearish. Moving along, we eventually get back to a situation similar to the start of this example, except a gap up on a much larger scale. Marking a potential line of support at the gap fill area is useful, whereas trying to do so on the advanced decline line is less useful, similar to previous examples. What is useful to confirm bearish strength of the move here is to see the advanced decline line also fall in the same direction as price, not so much the exact values the indicator falls under. As the trend continues further, we see a similar situation where the close coincidence of downswing points on the price chart and the indicator are more important than the exact values the indicator reaches. To confirm the strength of a continuation, we just care about downward movement of the indicator at around the same time price is also strongly declining, either with another downswing or breakdown of price reaching new lows. At first glance, this would appear to be a growing bullish trend. However, there's actually lower potential for further upside movement due to the indicator taking a more neutral to bearish stance. This kind of divergence lasting for a longer duration can indicate a potential reversal simply being a moderate to weak retracement within the larger established trend. Price on an individual stock chart is simply moving contrary to the broader market for a short time before it falls back in line with the sentiment for the majority of stocks. When there's prolonged disparity between the movements of the advanced decline line and price on a chart, there's greater potential for a large trend to form, particularly if it is a chart with falling price during a time when the market is mainly neutral to bullish. This is usually the case when talking about major reversals, but it can also apply to smaller continuations and breakouts in the short term. Next, we observe the difficulties of getting clear indications from the advanced decline line when the market has reached a period of relatively range-bound movement. Though once the reversal does get underway, we can see an example where there's an uptrend with price contrasted with bearish to neutral movement with the advanced decline line. After that, we get a good demonstration of some more minor divergence that doesn't lead to a major reversal, but still manages to congest and delay the existing uptrend. It's not uncommon to see this kind of activity take place when the market is indecisive with lower volume. When there is indecision, but with higher volatility and volume, it's possible to see divergence with the second swing point of a developing trend. In this case, there's a weak attempt to get back on the previous uptrend trajectory as price begins to fall sharply for this, and the majority of stocks in the market as displayed by the indicator, which was flat and indecisive during that short period before sentiment for this, and the majority of stocks in the stock market began to get back on the new trajectory of the developing bearish reversal. We begin with an established downtrend contacting firm support that is still under constant selling pressure. A bearish perspective would prefer a strong drop whereby the advanced decline line also continues to drop, along with price going under this threshold. Since this does not happen, it can indicate some weakness in terms of this stock not following the flow of the broader market. However, with price on a neutral to bullish path now and some divergence with the advanced decline line, it's not as straightforward as if there was a straight path up for both price and the indicator at this exact time. In the bigger picture, all these divergences turned out to be contributing to a major delay in the development of the larger downtrend. It's a familiar scene with the market remaining relatively flat as displayed by the advanced decline line while this individual stock drops quite a large amount in a relatively short time. Another case where a horizontal line on the price chart is useful, while the one on the indicator is not very helpful. With more divergence and failure for the stock to get above established resistance, it's not too unusual to see the return back to another sizable downtrend. And to end the example off on a positive note, we see the reverse occur for a major uptrend originating from prolonged divergence, where this stock began to take a bullish stance far in advance of the broader market. which was mostly bearish to neutral during the same approximate time. For more on indicators as well as Fibonacci methods, follow Ascencore. Thanks for watching and have a nice day.